Good morning, and welcome to Multitude's Q1 2025 earnings call. I'm Lasse Mäkelä, Chief Strategy and IR Officer of Multitude Group, and I will be your host during this call. This is going to be the last time that I'm hosting the call, as I will be moving to new challenges by the end of this month, but I will keep you posted about that later. Today, we will be hearing a presentation regarding our first quarter 2025 by our CEO Antti Kumpulainen and by our CFO Bernd Egger. Afterwards, there will be a questions and answers session. When the Q&A session starts, you can raise questions via the Q&A session at the bottom of your screen or via audio line by raising your hand with the hand button at the bottom of your screen. I would now like to hand over to our CEO, Antti Kumpulainen. Go ahead, Antti.
Thank you, Lasse. Good morning, everyone. My name is Antti Kumpulainen, and today is my first time as the CEO of Multitude Group, walking you through Multitude's earnings call and results for the first quarter of 2025 after being in my new role just over 100 days. As already familiar to many of you, our CFO, Mr. Bernd Egger, will join me in presenting our results. Year 2025 has started with a bang following our amazing year 2024 when we hit our guidance for the fourth year in a row. Today, we want to share with you some key takeaways. First, in Q1 2025, we achieved a 4.1% growth in revenue to 66.8 million euros. Second, we delivered a really strong net profit, which increased by 181% to 7.2 million euros. Third, impairment losses on loans decreased by over 21% year on year. And fourth, we increased our stake in Lea Bank in the first quarter, and we are the largest shareholder with a total stake of 24.49%. We are also increasing our net profit guidance of 23 million euro for 2025 to now be in the range of 24 to 26 million euros. This means that we are above our previous guidance and plan. We still have 3 quarters to go, but we want to increase the guidance already at this stage. I would like to spend a few minutes on reminding who we are, where we come from, and more importantly, where we are going. We were founded in Finland in 2005. Our registered seat is in Switzerland. We operate with a full EU-wide banking license, and we are listed on the Frankfurt Stock Exchange in the Prime Standard. During our 20-year journey, we have built a solid track record as a profitable global FinTech company, delivering an outstanding and fully digital customer experience focused on serving customers often overlooked by traditional banks. Since the beginning of our company, we have always strived to build and offer services to customers overlooked by traditional banks. Our vision is to build the most valuable financial platform for them. We believe this can be achieved by offering an amazing customer experience that is digital, fast, easy, and a green choice. We have built our FinTech platform, growth platform, to serve as the core with scalable components hosting the business units. The platform currently serves our 3 business units: consumer banking with Ferratum brand, business banking CapitalBox, which focuses on digital SME banking, and our newest business unit, wholesale banking with Multitude Bank brand. Our focus on the platform is to enhance scalability and constantly seek and be ready for new opportunities. Our company has from the very beginning aimed to grow profitably and following ESG principles. We are confident in our business model, which we have proved by delivering our profit targets consistently year after year, and for the last 4 years in a row, we have delivered our profit guidance. We are committed to our high dividend payout ratio, a target of between 25 to 50% of annual net profit. From last year's profit, we paid out a total dividend of 0.44 per share, being more than 46% of the net profit. Out of these 20 cents, or 25.4%, was a base dividend, and 20 cents an extraordinary dividend. We are continuing to follow our dream in building a company valued at 1 billion euros by end of year 2028. So then we are ready to go into the performance of Multitude in the first quarter of 2025 which was an outstanding start for the year. Demand in the market remains robust, and we have been able to strongly deliver on it. Revenue grew by 4.1%, and our net profit increased by an impressive 181%. One key factor in this was our continued good control of impairment losses, which decreased by 22% or 6.1 million euros year on year. This is thanks to our robust business model and high-performing teams who have been able to also make fast changes when needed. Profit this year is an important factor to follow after we went through re-domiciling last year and are currently in the process of restructuring and streamlining the organization further, which might have an impact on some financial metrics going forward. Multitude has the profitable growth in our DNA, which we aim to continue carrying forward. Each of our business units is in different life cycle, and each one is contributing to these results. Our investment in Lea Bank shares has continued, and our stake has increased to 24.49%, and we are the largest shareholder in Lea Bank. We continue to explore and prepare strategic cooperation between the companies. Multitude Bank's long-standing director, Mr. Erik Ferm, has also been appointed as a member of the board of directors in Lea Bank in the last AGM, 14th of May 2025. Going forward, we have clear focus. We are focusing on growing our business through our three pillars: organic growth, partnerships, and through M&A. Further to digitalize and automate our operations with extensive use of AI and data. And our net profit guidance in 2025 has been increased between 24 and 26 million euros. Let's take a closer look now at consumer banking, Ferratum. The focus for the business unit was to increase the profitability, which the team delivered on. Revenue was kept roughly at the same level year to year, while the EBT grew remarkably by almost 43%. One of the main aspects was improvements made in credit quality back in 2024, which is now bearing fruit even more than last year. Going forward, Ferratum is focusing on high profitability and also growth through partnerships and M&A opportunities. We successfully launched our first partnership case in Poland last year, and whilst that one has taken off well, we are also looking into new partnerships for this year. As we promised in our last full year earnings call, we will today announce the full year targets at every business unit level. For Ferratum, the main target is to grow the EBT at least by 5% for the full year of 2025. Then it's time to look into our business banking unit, CapitalBox. Last year, we focused on growth, which continued also in the first quarter this year. Major improvements in credit quality led to a decrease in impairments by 36% compared to first quarter of last year. This also led to EBT being substantially better as well, and we saw an improvement by 2.5 million euros year on year. Factoring product was launched both in Finland and Netherlands, with AI-driven solutions being in the center of the operations. Also, a big milestone was the successful launch of the secure lending offering for our customers in Denmark. Focus for CapitalBox going forward is to continue improving profitability without sacrificing growth. Increased usage of AI, automation, and utilizing data even more than today are the cornerstones of scaling the business and in a profitable way. Same way as in Ferratum, we will focus on driving growth in CapitalBox through organic sales, partnerships, and acquisition possibilities. For year 2025, CapitalBox target is to continue the double-digit growth and also to be profitable on a quarterly basis in the second half of the year. Then to our newest business unit, wholesale banking, which started its second full year of operations after being profitable already after the first year. Growth in revenue, EBT, and net AR has been really strong year on year. We have also added a new payment institution to our clientele in the first quarter, and more is on the way. The team has now been built to be ready for delivering on the strong pipeline we have both in secure debt and payments. Deal origination is getting faster and faster thanks to automated AI-driven processes and strong data analytics knowledge in the team. Looking forward, the wholesale banking team is focused on accelerating customer intake and is targeting to have an EBT more than 4 times higher than in 2024. Now I'm ready to hand over to Bernd, who will tell you about the financial performance for the first quarter. Bernd, please.
Thank you very much, Antti. Good morning to you all, and thank you for your interest in joining Multitude's earnings call for the first quarter. And we think it's a fairly exciting news that we want to bring across. As pointed out by Antti, our performance has been really convincing and actually above our expectations. Let us go into the details and take a look at P&L. First, I would like to focus on three key messages that, from my perspective, when it comes to analyzing financial performance, are particularly important. Message number one on P&L: financial performance is characterized by robust growth dynamics. We will look into the tribes in a little bit more detail, but on a consolidated, aggregated level, quite satisfactory top-line development. Number two, all those actions, and this might sound a little bit repetitive compared to the previous earnings calls, but it's really important to understand that the actions taken over the last full year to reduce credit risk and to improve credit risk performance are really paying off. So this is a very positive trend that is being continued. Message number three, the organization is scalable. At the same time, we invest in future growth, and those two factors, scalability of the organization and ambition to grow, further determine the cost structure of the organization. In terms of financial performance metrics in a little bit more detail, revenue now I can say comprising interest income and fee income, as for the first time we are generating meaningful fee income. We see an increase in interest income by 0.4% to 64.5 million, so essentially the same level as last year. But taking into consideration 1.9 million from fee income, this gets us to the 66.8 million, which represents a 4.1% increase compared to last year. So last year in Q1, we had 11k euro fee income. Now we have 1.9 million. There in turn are two drivers behind that. One is payment business, which is growing nicely. Secondly, partner business in consumer banking is growing nicely. And it's really positive to be in a position to make this statement, as this 1% reflects the strategy that we have announced about a year ago in that respect. Secondly, interest expense and net interest income. On interest expense, we see an increase from 8.6 million last year to 10.3 million in Q1 25. Compared to Q4 24, this is actually again now a drop by 400,000 euro in terms of interest expenses. This gets us to net interest income of slightly above 54 million, 54.1 to be precise for the first quarter, which compares to 55.5 same period last year, so a drop by a little bit more than 2.5%. Foreign exchange result slightly above last year, but actually below our expectations in terms of cost factor. And making reference to the layer topic, inter alia, pro rata profit share from investment in associates for the first time has increased to a meaningful proportion, is now reflecting with a little bit more than 500,000 positive in our P&L. Taking all this together results in net operating income of 55.9 million for the first quarter. This is an increase of around about 1% compared to last year. With that, let me move to the second key message with regards to the P&L analysis, and that is credit losses. This has been, as pointed out, the top priority for the full year 2024, and it's also a top priority for 2025. It's an extremely decisive factor behind the profitability increase that we have seen over the last two quarters, or actually profitability boost, I could say. Credit risk performance has improved very significantly in absolute numbers, a drop from 28 million, more than 28 million to 22.2 million in the first quarter. So we have very effectively reduced credit losses by 6.1 million compared to last year. This is a drop by 22% compared to the 24 level. So really a remarkable performance. Cost management, that relates to the scalability of the organization. Personal expenses pretty much on the same level, in fact, decreasing by 2% compared to last year, current at 9.2 million, so very well on track. Operational expenses, we see a slight increase by 1.3 million compared to last year. The key drivers behind that are, on the one hand side, strategic projects. So this is this the double-sided coin in a way. We want to make sure that the organization is scalable and cost-effective and efficient. And secondly, we are actively investing in forward-looking strategic projects. Secondly, audit-related expenses, compliance-related expenses are going up, whether we like it or not. That is part of regulated business. And thirdly, 50% of OPEX or general and admin expense increase is actually driven by growth, in this case by higher depositor compensation scheme expenses. Depreciation expenses, marketing, other expenses largely flat compared to last year. So from the overall perspective, we're really satisfied also with cost performance. Now let us take a look how these developments in revenue and financial expense, cost of credit and operational expense translate into profitability. And this is again at the core and the heart of this presentation, since this is really something we are in fact proud of. Profit before tax increasing massively from slightly below 3 million last year to 8.3 million. This is an increase in profit before tax by 5.3 million in one quarter, or plus 177%. Assuming a stable effective tax rate of 13 to 14%, and this, by the way, is going to be a constant assumption throughout the year, this results in net profit of 7.2 million. Again, a very significant increase of 4.7 million compared to last year, plus 181%. So really top performance. With that, let's briefly move on to the balance sheet and talk about the assets. I will limit myself to two key messages here on slide 14. So that's on the one hand side, cash. We have sufficient cash resources in order to increase our portfolios going forward, both in loans, but also investments in the wholesale banking business. Plus, on top of that, we have sufficient cash resources also for unorganic growth opportunities, M&A transactions that might materialize in the course of this year. And secondly, not so much as a surprise, total increase of around about 25 million in terms of investment in portfolios, so loan portfolio size and investment in the wholesale banking business. With that, on the balance sheet, referring to liabilities and equity, there are only two remarks I would like to make, in fact, three. Deposits current at 888 million, still the main source of funding for a number of reasons. Secondly, we've increased a liability position. Technically, it's a liability position in IFRS terms. In regulatory terms, it's capital. The bank has, for the first time, successfully placed a Tier 2 instrument in the amount of 25 million euro, which is reflected in the balance sheet as a liability, but as pointed out, is regulatory capital on the level of our subsidiary Multitude Bank. And finally, equity, end of Q1 at 200.6 million, and the net equity ratio as per bond covenant definition on a very comfortable and solid 25.4%, an increase by 2.2 percentage points. Let's take a little bit of a deeper look into the segment performance on the next page. And I will try to make reference also to how Antti described the way forward, what the 25 targets are. Kicking off with Ferratum, I think I'm in a lucky position to make the statement that Ferratum again has performed extremely well, especially when it comes to profitability. Revenue de facto on the same level. But what is important to us, the business has started generating fee income, 1.9 million in the consumer business. So really also from a strategic perspective, something that we have pushed in the middle of our monetarization strategy and now is paying off. So this is a positive news as well. Operational expenses well under control, credit losses extremely well under control. So the average credit loss levels over the last 3 quarters in 2024 was 19.2 million. Before that, we were on 5 to 6 million higher level. Now we are at 19.1 million, so even lower level, despite the fact that portfolio is growing. So this is really a top performance. And this gets us to, for the Ferratum, for the consumer banking business, to profit before tax, an increase from 22.9 to 32.9, plus 10 million, plus 43%. 0.7%. So really top performance. Let's continue with CapitalBox. We are satisfied with top line development plus 11% to 8.6 million, which is on a quarterly level all-time high for the CapitalBox team. Credit losses, again, as a recap, we've made this very clear and we've been transparent about that we were not happy with the credit loss performance beginning of 2024. Picture has changed dramatically in a positive sense. Credit loss levels reduced from 4 million to 2.5 million, minus 36%. I have an extra slide outlining the details on what is actually driving that. Why can we consider, or why are we considering this to be of a sustainable nature, this reduction in credit losses? For us, really very good news. And again, factoring in that this reduction in absolute numbers from 4 million to 2.5 million credit losses is to be seen in the context that the portfolio has increased by 20 million in the same time. So in fact, relatively speaking, even more compelling performance. Cost structure also from a P&L perspective for CapitalBox in light of the ambition to turn the business profitable, super important following the integration of the acquired Danish Omniveta factoring business and also some quite numerous efficiency initiatives. Operational expenses are now on a actually significantly lower level than last year, minus 10% to 4.7 million. So not only growth, but also efficiency of the organization is at the core of what the CapitalBox management is focusing on. And as a consequence of these higher revenues, reduced credit losses and lower cost levels, EBT contribution has improved significantly to minus 0.6 million. So that means we have cut 80% of losses compared to last year already. And as Antti pointed out, the target is to get the business positive, profitable on earnings before tax level on a quarterly level still during 2025. Finally, wholesale banking, a success story so far. Revenue up to 4.4 million, which compares to 2.3 million in 24, growing by 2.1. So essentially doubling the business from top line angle, credit loss performance, collateralized business. So pledged assets de facto cover expected credit losses. So only a slight increase, but less than 1 million altogether. So that is very well under control. As an early stage business, operational expenses are higher than last year. Growth rate is digressive, plus 33%. So as we've pointed out in the past already, it's about building up the resources, the processes, the systems, and also the capabilities in terms of human resources. That's done. And now we are in a position to scale. And that translates into positive earnings before tax of 0.7 million for the first quarter, with the ambition of growing profitability by factor 4 for the full year 25 compared to last year. So from slightly above 1 million to between 4 and 5 million this year. On slide 17, a slide you are familiar with, asset quality. Just spent a couple of seconds on this one. What is important is the long-term trend. So you see a long-term trend of improving asset quality. So credit losses in relation to portfolio size is decreasing over time. Highly scalable business. I've pointed this out in the past as well. Negatively disruptive event hardly have any impact on the asset quality currently. So this is really very well under control. And on slide 18, as pointed out, more information on what is actually driving credit loss performance. And if I may summarize for all the businesses, for the consumer business and for the SME business and the nature of wholesale banking is slightly different. What they have in common is that we have changes, improvements in the methodology, so in the underwriting, with operational improvements that are paying off, and in the end, with also organizational processes that now are streamlined and help us focusing on profitable markets, and that is paying off by, as pointed out, in total 6 million lower credit losses than last year. So a quick look at funding structure. Also positive news here. We have a very solid cash position enabling us to grow. Key message number 1. Key message number 2, we don't have any upcoming repayments. So we have time and energy now to focus on some improvements and optimization in terms of funding structure going forward. We have successfully in Q1 issued a Tier 2 instrument on the level of the bank, first time non-dilutive equity capital position in the organization on the level of the bank. So this also is a milestone that we have managed to complete successfully. And then I would like to move on to the guidance update. The reason why we are doing this now is in fact that we have seen after the 9-month presentation, when we have issued the 23 million guidance for 2025, we've seen an extremely strong Q4 performance, plus now on top of that, extremely strong Q1 25 performance. And taking that in combination, we think it's the right point in time, together with the confidence that we have in terms of credit loss management, in terms of scalability of the organization, to improve our guidance and to increase it from 23 million to 24 to 26 million euro. The key assumptions remain valid. You can see them on the slide. I will not go through them one by one. Naturally, the ability to achieve the guidance is subject to a number of assumptions, the absence of negatively disruptive events and all that. But I think we have demonstrated over the last couple of quarters that we are not only in a position to achieve our targets for 25, but might be in a position to exceed them, hence the update on the 25 guidance. Now, finally, before I hand over to Antti again, I would like to share information on our team. Investor Relations is from today onwards going to be led by Adam Hansson Turning. He's going to run Investor Relations and also Treasury. Lasse has already informed you that this is the last presentation that he's going to host. Thank you, Lasse, very much for the great cooperation over many years. It's really been fun and a successful couple of years. So thank you very much for that. About Adam, he has gained a lot of valuable experience in the organization. He's still young, but he has run the FP&A organization for more than a decade very successfully. He has a profound educational background, strong with numbers and analytical skills, and has just last year successfully completed his MBA at the IMD in Lausanne. He will be working with Antti and myself very closely, and also is here, of course, to work with you, the investors, and I'm sure that you will enjoy working with him as well. With that, Antti, I would like to hand over back to you, and then I guess we are open to take questions.
Exactly. Thank you, Bernd. So, just to repeat our key takeaways still from the presentation. Increased revenue by 4.1%, now to 66.8 million euros. Really, really strong net profit, which increased by 181 to 7.2 million euros. Thirdly, the impairment losses, which decreased massively by 21% year on year. Lea Bank stake up to 24.49, and we are now the largest shareholder, as we have now been for a short while already in the Lea Bank. And the most important message now for you in this call is that we are increasing the net profit guidance from 23 million euros in 2025 to be in the range of 24 to 26 million euros. Thank you. I think we are ready to take the questions. I think we have already a few. If I understood correctly, Lasse.
Yes. So thanks thank you, Antti and Bernd. Just the instructions still for the questions, just in case people don't remember what I said earlier. So you can raise questions via the Q&A section. Section. So you see that underneath on your sort of like a Zoom table. Or then if you want to raise questions via audio line, please again hit the hand button at the bottom of the screen. So then we can take the audio questions first and go forward with that. And finally, if you ask in an audio line, please speak clearly and slowly so that all the participants can hear your questions. Good. We are ready. so far we don't see any audio questions, but maybe we can start with the written questions there.
Yes.
Good.
Let's do so.
So there is a question from Mark Luthi about impairments. If I take this one, Bernd. So
yes, please go ahead. Yeah.
Mark is asking, impairment decreased nicely, and the question is this is a one-off, or do we believe that we can keep in these levels? As Bernd already showed in the slides before, we have had this trend of decreasing impairments now for a long time already. So we believe that we can maintain the same trend, and we do not see any bigger risk from that perspective. Having said this, we always have volatility in impairments due to seasonalities and other factors. So there might be volatility in the credit losses, but our view is that the same trend we have had for the longer time period is still there. Good. Then, Bernd, do you want to take on the Ferratum loan book growth?
Yes, another question related to Ferratum. Nice growth on loan book, 8.3%. Why is the margin decreasing so much? Interest income minus 4.1%, expense plus 8.2%. Is it a question of quality of credit risk and slower margin, or is it a question of ALM? Well, in the end, I think there are two aspects I would like to raise. First of all, when it comes to loan book and interest income increase, what is our top priority in both, by the way, in the management of consumer business, but also SMEs, focus on profitability. So it's not so much on top line development. We are focusing on our ability to increase profitability. So that means that those portfolios are not static. From time to time, it is the right thing to do to focus on markets that are more profitable, where the underwriting quality, where the collection performance, where the ability to sell non-performing loans is higher than in other markets. So focus is always on profitability first. This is why interest income drop doesn't change at all our ambition to develop and to maintain profitable growth. Second factor, this 4.1% drop in interest income is de facto completely offset by the 1.9 million that for the first time the business managed to generate as fee. And this is something that we like a lot, because this means lower balance sheet volume or weight. This means that we develop a more balanced monetization strategy. So this is both is in the region of 1.9 million, 2 million. So this is offsetting very nicely. Expense 8.2%. I think in fact it's 6.8%, but that's delta is peanut. So this is the trend that counts. I think the organization is super scalable. 8% or 6% growth in cost is maybe less decisive from our perspective again than how this translates into profitability. And profitability, despite the fact that we are investing, this is where the growth is coming from in expenses, investing in new business models, that we are investigating new markets, developing new business models, such as the one in Poland that Antti referred to. Profit before tax up by 10 million. So from 22.9 to 32.9 million, already factoring in, obviously, this slight increase in expense. That's a 43% increase in profitability. So as long as we're able to see very significant growth in profitability, we are actually very well prepared to accept an expense increase in order to make sure that we continue grow and continue to develop new business models. Should I take the next one?
Yes,
Investment in
please.
associates. Again, Mark Luthi, investment in associates on the balance sheet, 24.1 million. I assume this is your investment, Lea, is 24.1 million the historical cost, or is this the market value? Also for the P&L, 500,000 from associates is this pro rata share of net profit of Lea in Q1. So a structural response to that first. Lea is not the only associate that we have. We have currently 2 investments in associates. So that is the combined amount of Lea and another one, a broker business that is also operating very successfully. Both our investments are at cost. So reflections of market fluctuations. Lea is, as you know, a listed bank as well, or listed company as well, are not reflected in our balance sheet. And the P&L impact of a little bit more than 500,000 from associates is the combined effect of those 2 companies, the majority of which is coming from Lea Bank.
Then we have a question about the exceptional expense items in Q1 for the move.
Yes, this is related to restructuring of the company and the relocation or a move to Zug. There is not one exceptional expense, but as Antti has pointed this out in his presentation, that we are in the process of restructuring. We want to reduce the number of legal entities. We want to streamline the organization. We want to create a leaner organization, and that by definition inevitably comes with some cost, tax advice, legal advice, financial treatment of those entities, preparation, evaluation of optimal structure. So this comes at the cost. Cost will be, in this case, for this year, at least is our expectation, lower than last year. But this restructuring, reorganization, streamlining of the organization will trigger some cost. Nonetheless, this is factored in our guidance. So despite the fact that we have to incur some cost, internal and external, we are comfortable with the guidance increase to 24 to 26.
Thank you. Then there were a few questions from Roni Peuranheimo from Inderes, and actually you answered already a few of them here at the same time. So the first one, Roni is asking that wholesale banking loans to customers plus debt investments growth that flattened on Q-on-Q basis, and how does the growth look forward? So how we can see is that in wholesale banking, it always takes time to prepare the cases. So Q1, we've been now ramping up the accelerated growth for further of the year. So we can see that the unit is accelerating. We still have a quite well growth on year basis, doubling the net AR, almost doubling everything there. So I see it really bright going forward. And also we have now started to add mainly here in Q1 the payment fee income from the payment business. This is extremely important for us. We can see that the elements that are supporting the growth for 2025 is obviously now the accelerating of the deal origination and making sure that we close the strong pipeline that we have. And then, of course, adding new fee income within the wholesale banking unit. Restructuring questions already Bernd answered on. Then question also from Roni is that if we have seen any significant changes on demand on market or payment behavior. No, we have not. We can, for instance, see now that the payment behavior, as we can see, based on the decrease of the impairments, that vice versa, we have now really good situation there on the credit loss side. So it means that customers are really well paying back the loans as well. And then the fee income question from Peter Irblad. I can take it a bit as well. So
whatever you prefer, yeah. You can start and I keep going.
So we have on 2 different fee income streams, which we can say that are main income streams at the moment. One is the partnership we have and partnerships in Ferratum in the future. This is generating fee income through the partners. Then the other one is what I just told about, wholesale banking and payment business. So we are serving electronic money institutions, payment service providers for their payment infrastructure, and this is generating the income for the company.
Yes, and maybe if I may add, Peter also raised the question whether this is sustainable. It's always a little bit tricky when it comes to forward-looking statements, but the nature of the business makes us believe, or at least the ambition of setting up those businesses is of sustainable nature. So both the partnership model that the consumer banking team entered into, and also the payment business that starts paying off and generating fee income, so non-risk income in both cases, is to be expected that it is sustainable.
Mm.
Should I continue? There is another question raised by Peter Earblad. Net AR growth still very dependent on Ferratum, while CapitalBox still has quite weak AR growth. AR is account receivables. When will we see acceleration in CapitalBox? I think two statements on this one. First of all, it is growing by around about 20 million compared to last year. And that is also an exception rather than the rule, since the SME financing business is in a difficult shape. In Europe, we see many players opting out of the market and in the end reducing their exposure. I think it is a top performance that the CapitalBox team managed to increase both portfolio size and top line growth, and at the same time cut credit losses by 36%. So those two factors taken into consideration is actually very positive. You are right. Current growth levels when it comes to portfolio size and revenue between 11 and 12% is not on the same level as last year. But again, we are comfortable enough to assume and expect that CapitalBox business will be earnings before tax profitable in the second half of the year on a quarterly basis. So we expect that this growth momentum will prevail. How quickly it will go to higher double-digit growth rates, we will see. But currently, I think the balance between growth and credit loss performance is actually quite good.
Good. Then we have a question from Gedeon Kruse regarding our plans for Lea Bank. That is it more of a financial investment, or are we seeking to actively influence the operations? So first of all, I would say this is partly both, that we see this as a superb financial investment, and we are looking for cooperation from a strategic perspective. We have to remember still that the companies are two independent companies, but we still do see that we have lots of possibilities for more strategic cooperation going forward. And we are just in starting in that phase. We have been owners now for roughly a quarter.
Good. Then maybe I continue, as I think I answered the question, Mark Luthi, on Ferratum business and the fee income. And I think actually there's no question, rather the invitation to keep investors updated in which direction this is going. And yes, we will do that.
Good. Then we mentioned about there's an anonymous attendee asking about reducing operational costs, streamlining. Where do you think that there's potential to do so in the businesses? I would say in multiple places we are already quite far in automation and use of AI, making sure that we are scalable. Having said this, we still can be much better in that front. So we see it across our organization that we can increase still the usage of data, making sure that we use more AI, automate even more, digitalize even more. So this is a continuous journey. Like Bernd also mentioned earlier on, we also have been reorganizing the company structure, about making sure that we have a right amount of entities in right places, etc. So there are multiple smaller factors. Do you want to add something on this, Bernd?
No, 100% agree. I guess these are the main factors that we see.
Good. Okay. The priorities for the next years was also one question that was already answered in the presentation, but I will reiterate that once more. So one is what I already said, further automation, use of AI, and then we have our 3 growth drivers in a multitude that we still continue on, and they are organic growth. We are growing through partnerships and also actively seeking and expanding on M&A opportunities.
100% agree.
Good. I hope so.
It looks like we have not received any audio questions so far. And it looks like we have pretty much answered all the questions what we have received. So unless there are any other closing words, Antti and Bernd, you wanna?
No, I think we are done, and it was really enjoyment from my side to host the first quarterly call, and more to come in the future. Thank you. I wish you all a good day.
Yeah, and also thank you very much for everybody joining the call. And this concludes our call today. And from my personal side, it has been a pleasure to work with all of you, and I'm sure we will be meeting and touching in the future. The paths will cross. But anyway, thank you very much and goodbye.
Thank you, Lasse.